Hey everyone, we got some big news out of Etsy today, and I'm going to share with you what that news is and what it could mean for Etsy shareholders. Now, Etsy stock has been one of my top stocks to buy in 2023. I've reiterated that recommendation nearly all year long, and Etsy stock has been one of the disappointing performers in my group of top stocks to buy. I've recommended stocks like Alphabet, which is up 50% on the year, Meta Platforms, which is up about 100, 200% on the year. But Etsy's been one of those stocks in my group of top stocks that has underperformed. So in this video, I'm also going to update that recommendation of Etsy stock. Is it still going to be in my list of top stocks to buy? Maybe, maybe not. So you're going to want to stay tuned, listen to this news, and hear my update for my top stock to buy Etsy. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the big news that came out today was a restructuring plan from Etsy management. And the plan includes an approximately 11% reduction of the Etsy marketplace workforce, which is approximately 225 employees. Now, in connection with this restructuring plan, Etsy estimates that it will incur approximately 25 million to 30 million in charges, and the plan will be substantially complete by the first quarter of 2024. Now, if you've heard me make videos about these types of restructuring plans, Meta Platforms did one, Alphabet did one, Amazon did one in 2023, you will know that I'm not a fan of these kinds of restructuring plans. They are expensive. Look at the cost here, 25 to 30 million in charges to let go of 225 employees. Even if you average out the salary of these employees as 100,000 per year, which is stretching it really high, the annual cost of those employees might be 20 million, 25 million for a whole year. But you're paying 25 to 30 million to let them go. I'm not a fan of that high cost letting go, firing, restructuring, whatever you want to call it. It's too expensive in my opinion. I prefer management teams take an attrition approach, right? Let the people that don't want to be there quit. Every month, every quarter, there's going to be employees that quit. There's going to be employees that find jobs elsewhere. Let them quit and don't replace them. And that way you shrink your workforce with self-selection. Those employees that no longer are enthusiastic about being with your company, they voluntarily leave. And you're left with a skinnier company, a thinner company, less costs, and it's not as expensive. It's not as disruptive to your operations. Now, I would understand a restructuring if, let's say, you're operating 3 business units and you decide that one of those business units is no longer part of your future, that you need to cut off that unit, right? And those employees that are all in that unit need to be let go because they have a certain set of skills that is connected to that business unit and they can't be incorporated to the rest of the business. In that case, yes, you let them all go. It's just part of the need to get rid of that one business segment. But that's not what's happening here. Etsy's marketplace is still a core business function for them. That is what they do. That is the business. It's a marketplace that brings together buyers and sellers. And so this, in my opinion, again, I've said this with when Meta Platforms did it, when Amazon did it, when Alphabet did it. I'm not a fan of these moves. I'm not a fan of these moves. It signals, first of all, that you hired too much, that you got ahead of yourself, and now you're needing to restructure, you're needing to let go of these many employees. It's not a good sign for the prospects. It's not a good sign of management. It's not a good sign for the hiring, right? Your hiring process. It's not in line with your business operations. And so all in all, I'm not a fan of this move. So along with this announcement, Etsy gave an update on what they think their fourth quarter is going to look like. And they say that consolidated GMS, which is gross merchandise sales on the platform, will decline by approximately 1 to 2%. and revenue will increase by approximately 2 to 3%. Adjusted EBITDA margin will be approximately 27 to 28%. This is roughly in line with the estimates that Etsy gave investors when they released their third quarter earnings results. So no big change here from their estimates. Gross merchandise sales declining. The company expected that gross merchandise sales to decline by low single digits. This was all expected, nothing new with their fourth quarter estimates, but investors should be reassured by these figures given when a company announces a major restructuring plan in the middle of a quarter. That indicates that maybe something went significantly wrong in the quarter, and so the quarter's results might be much worse than they were expecting, but that's not the case here. The quarter is not going much worse than Etsy is expecting. They just felt like they needed to do this restructuring. So I mentioned already gross merchandise sales, and in the most recent quarter, Etsy's gross merchandise sales increased by 1% and revenue increased by 7%. So the fourth quarter is an overall turnaround from the third quarter, but management was already expecting that slowdown in the fourth quarter. Overall, though, the business was doing relatively well. They added in the most recent quarter 19% year over year growth in active sellers and 3.4% growth in active buyers. And this is really the core of the business. This is, if I was an investor in Etsy stock, which I'm not. I don't own Etsy stock. I do recommend Etsy stock as a buy. As I mentioned, it was recommended as one of my top stocks to buy. And this is the reason. This is the reason I liked Etsy stock so much, is because it's a platform that brings together buyers and sellers, doesn't own any inventory, and that's a lucrative business model. The company was making good profitability on its metrics in the most recent quarter, 13.8% net profit margin on gross merchandise sales of $3 billion and revenue of $636 million. So the business is generating good profitability, strong cash flow, and I like the business model, the asset-light business model. Sure, the company experienced I would say, market share loss in 2023, right? E-commerce is expected to have grown by roughly 8% for the year, but gross merchandise sales on Etsy's platform is down 1.4% in the 9 months, and it's expected to fall again in the fourth quarter. So while e-commerce sales increased by 8% on the year, sales on the Etsy platform are going to decline by about 1 or 2% for the year. So it was a trailer behind the market. It lost market share for the year. And my hunch for why the company lost market share in the year is because it had done an aggressive increase in the take rate. What I want you to pay attention to here is in the orange. In the middle of the orange, there's this line going across here. This is Etsy's take rate, right? I mentioned that Etsy brings together buyers and sellers, and it takes a percentage of each transaction from the platform, and that's the take rate. And it was aggressively increasing this from 19% in the second quarter of 2022 all the way up to 21% in the third quarter of 2021. To put this figure into context, eBay is at roughly 12% of take rate. So Etsy is way above eBay, and it's a similar platform, and it's been more aggressive in raising this take rate. So it's understandable that it would lose market share because its pricing is more aggressive, right? Its pricing is more aggressive. Unlike others who offer better terms, of course, they're more likely to gain market share because they're offering better terms, right? If you're charging a seller 20%, 21%, then that seller is probably going to raise prices on their products and thereby discourage some buyers from purchasing. Because then the seller is going to say, well, I'm not going to sell my product at a lower price because Etsy is going to take 21% from my sale. So I need to increase my price so that I can generate a profit from those sales. And so this elevated price has caused Etsy to lose market share. It's caused Etsy to lose market share. The good news for long-term investors is that Etsy can lower this. They can lower this, right? If they want to retake market share, and if they feel that market share is more important than profitability, they can decrease the take rate or offer some promotions to sellers. and thereby attract sellers to discount more and offer their products at lower prices. And then buyers will see lower prices and they'll be more encouraged to join their platform, and they can cause that virtuous cycle rising again. They could do that if they wanted to. Although I wouldn't want them to. If I was a shareholder, I wouldn't want them to do that. I've always said that I'm not a fan of lowering prices to take market share. I don't like that strategy. I prefer companies try to differentiate and increase their uniqueness, their customer value proposition to gain market share instead of lowering prices. The saying goes, right? Any fool can lower prices. It's not really a business strategy to just say, let me cut prices, right? It doesn't take any skill to do that. I'd prefer a company to use skill to try and gain market share rather than just lower price. And so, of course, investors were not happy about this news today of the restructuring. Like myself, I was not happy with this news, but I'm not a shareholder. If I was, I may consider selling. The stock is down 5% on the day. It was down as much as 9% on the day. Still, Etsy stock is not expensive, even after it rallied after the bottom in October in terms of valuation. The forward price to earnings is at 16.91. Stock is still relatively cheap. I still like the core of the business model. I'm not a fan of management's strategy and direction and the moves they've made over the last couple of years. To name a few, they hired too many people, too many acquisitions, and now they've been having to divest some of that. And now this move with the restructuring. So management strategy and management decision making, I've downgraded that. I don't like their moves. And even with companies like Alphabet, I felt like they were hiring too many people. They got sloppy and careless a little bit. But the business, the core business, was so lucrative and so profitable that I overlooked that, right? Because it's just such a profitable business model. Like there's very few businesses as lucrative as Alphabet. But Etsy, the business is not as lucrative. You can't afford to make these kinds of mistakes too often when your business is not that profitable to begin with. It's not that lucrative to begin with. So, for all of these reasons I mentioned, I am downgrading Etsy stock here. I'm no longer rating it as one of my top stocks to buy. I still would rate Etsy stock as a buy given the business model, the asset-like business model, the high take rate and the flexibility it offers management, the relatively cheap valuation, and the industry. E-commerce is expected to grow overall significantly over the next decade. And so Etsy's participating in that tailwind. So for those reasons, I still recommend Etsy stock as a buy. It's just no longer one of my top stocks to buy. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.